Hello, my name is Maura Ginty. I'm a tax advisor. My firm is Gintax, and my talk today is on tax planning for business owners, starting out and in particular finishing up and the end game for tax. Tax aspects you need to be wary of when you're finishing up. It's something that most business owners, they're too busy with the business, growth, survival, but not the end game. So just want to think a little bit about that aspect today. I'll start off briefly because it's relevant for a good few of you in the room is tax structuring at startup phase. And I suppose I just want to let you know that it's not something that you should overly complicate. It's relatively straightforward, in particular if it's just you on your own. You've broadly got a choice of operating in your own name as a business or else setting up a company. A company has the main advantage of limited liability. If something goes wrong, it's the company that's sued, it's not you. And as respects tax, where you are, we'll say, where you are spending personally all of your business profits, then there's no real difference from a tax perspective, or no real tax saving in having a company or setting up individually. And I'd often just say the main thing is just to go for it. Start out in your own name. You'll always have flexibility in transferring into a company and setting up a company again. In setting up a company again once you become successful and start generating excess money, just as a rule of thumb. And just one other general thing to bear in mind with tax is just to ensure from the very start that you're tax compliant. This area is not rocket science. If you're not a disruptor, then your business is relatively straightforward. It's been done, or something similar has been done hundreds of times. So it's just getting the information, getting a good advisor, or figuring out exactly what your tax compliance obligations are. The Irish Revenue website even is very intuitive and good as respects startups, and just ensuring you're compliant. And the main thing with tax is that you sleep easy at night, essentially. And I'd always just generally advise, even if you think you know it all or you've done your research, just to get a heads up from an accountant or a professional, just generally as respects your plan and your structure. In the majority of instances, it will be standard or straightforward, but there may be one particular nuance to your own, to your fact pattern that's different, and you'd need a heads up or it to be drawn to your attention. And that's throughout the business cycle. If you're doing anything new or different, out of the ordinary, then it's good to have someone you can run these things by. That's a general overview of starting up, which you've all been through. Less popular is the tax on the end game. And when I say the end game, I'm talking about having a company that's created value and doing things like, we'll say, selling the company or liquidation, retirement, or even succession, transferring it to the next generation, or a mixture of one or two, or possibly in really complex situations, all four of those transactions. And it's really important from the outset to think about tax on those. And the reason it is because as your business is growing and operating, if you were to take any money generally out of a company, you're subject to high income tax rates. And about the only time you can get money into the paw at lower than the high marginal rates, which are 52-55%, is on one of these exit events. And I suppose to take you through just broadly the basic example, you sell your company. That's within the scope of capital gains tax, and you have a rate of 33% on the gain. I know that's fine. 33% is a lot better than your high level income tax rate, but there's a lot of reliefs there targeted at business owners like yourselves, which can reduce that rate to in some cases completely zero. Now I've got some slides just to detail the rates, sharing from beginning, starting out, finishing up. Yeah. So probably the main one, we'll just go through them in sequence, right? And the main one you've probably heard of or heard anecdotally is this entrepreneur relief. There's various conditions. The main one is that it applies to gains of up to 1 million, and it's a 10% rate rather than the 33%, which is a really, really good result, really good result for business owners. Moving on from that, for really valuable, more valuable businesses that are in a probably more complex structure, there may be various elements to the business, then disposals tend to take place within the group. A holding company might sell one of its subsidiaries. And generally in that instance, you can also receive, or the group can receive, a 0% rate. Now the money is within the corporate structure, it's not in your paw. But in that situation, when you're talking about the multi-millions, people don't necessarily need 5 or 6 million in their own hands. It generally tends to be within the corporate structure and left there to roll up. Moving a little bit back down to reality for many people, the other relief, and a very common relief as well, is retirement relief, which is a 0% rate. There's lots of conditions. It potentially kicks in when you're 55, and the relief is capped generally at 750,000 of proceeds, but there's no limit. There's no limit on transfers to children. At the age of 66, then the conditions are restricted somewhat, and the limits are reduced. So you'll often see a lot of planning, birthday planning in around your 55th, or people planning in around their 55th or 66th birthdays. And that relief works very well with transferring your business to a successor or a child. Multi-million euro businesses can transfer without tax in that manner. In those situations, you also need to think about gift tax, and there's various reliefs there which need to be considered, potentially reducing the overall tax to a nominal amount. And all this generally, there's on leaving a business, you can potentially receive a termination payment of about 200 grand tax free. So all of those reliefs are potentially may or may not apply, or some may, an interaction of them all. As you can imagine, there's various conditions attaching to all of them, and a whole raft of kind of complicated anti-avoidance rules in that, as you can imagine, income tax is at a rate of potentially 55% in the country. So in the past, there might have been artificial type transactions to get you into these rates. So there's a lot of complicated rules. But in the main, it may not be your situation, and the vast majority of situations may not be complicated, and it may be just one little change to your structure might completely make it way more efficient. And I'm going to give you a really basic example that was real life clients of mine, actually. Mary set up a business, a technology business, and it looked like it would be successful. Herself and the husband, her husband came to join her, both gave up their jobs, worked full time, and the business was worth around 2 million. She was in her 40s, so retirement relief not available, but this entrepreneur relief, great, 10% rate at her up to the first million. Now, where Mary held all the shares, then she would have only got 10% of the first million, the rest would have been subject to tax at 33%. If herself and Paul held the shares jointly, then both of them would have qualified for the 10% rate, and their final tax in that scenario would have been just 200,000. So it would have been a saving of around over 200,000 again. And I suppose the key point to note is that it would be no good Mary coming to me 3 or 4 months before the sale and saying, can she transfer half the shares into Paul's name? One of the conditions for entrepreneur relief is that Paul would have needed to hold the shares for 3 years before the sale. So in that instance, they'd be my clients from day dot, and we put that structure in place from the start. But you can see how something simple can potentially make your transaction a lot more efficient than it otherwise would be. Probably less so. I just want to touch on one issue that was common enough, I'd imagine less so this year, but hopefully will be in the future. And it's a common question, is generating excess profits or excess cash in a company and what to do. And broadly, there's 2 choices. One is the company invests it in business assets or some other investment assets and goes off, and you try and think about targeting one of the reliefs one of the reliefs that I mentioned earlier. And just as a rule of thumb, it's always better in that instance for where the company has invested in, we'll say, a business asset, like we'll say a premises, rather than government bonds or something. That's one option. Or the alternative is that the company can contribute to your pension fund, which you know and love and have heard of a million times, but it's always useful. An awful lot of people have one idea or another idea of pension funds. So I'm just going to go through at a high level the pros and cons, and it's for each person can decide for themselves if it suits their particular fact pattern. Now, the main advantage of contributing to a pension fund is it's very tax efficient. Company has profits, it whips them out into the pension, and there's no tax. Now, that's subject to pension funding rules, which are relatively flexible, and your pension advisor will be able to tell you, will be able to go through them with you. Now, when I say relatively flexible, I mean where a company or an employer are making a contribution, less so if you yourself personally are putting them in, but that's for another day. So there's that efficiency. The other ones are pension funds don't pay tax. The profits roll up in the pension fund without tax. They're relatively simple. You don't need to think about it ever again until retirement. And at retirement, you can take a nice lump sum tax-free. The majority is subject to tax, but as an older person, you probably don't have that much other income in any event, and there's generous enough tax-free limits and bans and whatever else. The cons, again, probably what you'd be able to go through or people will be able to rhyme off is that the money is locked away. It's not there for your rainy day. It's subject to the future and probably pension levies, maybe different rules. You have no control over it. There is costs. Pension funds and advisors are able to charge management fees. You can do it yourself. You can have your own self-administered scheme, but even then you'll need trustees, and there is management time involved. And generally, as a rule of thumb, and it would be great, you'd be well set up if you can try and build up a pension fund of around 2 million. After that, there's inefficiencies, and it's costly. So that's broadly it for pensions and just generally. And I'm going to have a link to these slides on the presentation, just as a kind of an aid memoir of what is, and just to kind of tweak your mind. I'll leave it there, and I'll give you one to do, is that every year you look at your compliance and you've got a tax return to file or accounts, you'll be chatting to your accountant and just mention to them your end game. And in the majority of instances, they'll be able to tell you if there's an easy win, like the Mary and Paul, or if your situation's a bit more complicated, or you may need tax advice at this stage, or else maybe in a few years' time. In particular, this is really crucial. If there's a lot of value in your company, you might have a buyer in a few years' time, or you're due to retire in 10 years' time, then you need to have this really on the agenda, and just at least starting the conversation and seeing whether, and just ensuring that you're as efficient as possible. That's great. Thank you very much for listening, and I hope you enjoy the rest of the conference.